Welcome to the Deep Dive. Today is July 22, 2025, and we're unpacking quite a stack of sources today.
We certainly are.
They give us a real snapshot of where things stand right now. We're talking big economic currents, shaping our wallets, the cutting edge of AI, and even some, well, surprising shifts in how we live and work.
Yeah.
Our mission, as always, pull out those crucial nuggets of knowledge, help you feel truly well-informed without getting buried in the noise.
Absolutely. And we're going to connect quite a few dots for you today, I think. We'll look at global trade policies, their impacts, sometimes surprising impacts
Right.
on different industries. Then there are these fundamental shifts in, how we work, how we spend,
Okay.
and even touching on the future of personal finance. What's really fascinating, I find, is how things that seem totally separate
Yeah.
actually weave together into this bigger picture that, well, it affects all of us, directly or indirectly.
Okay, let's unpack this then. We've got market reports, earnings calls, economic analyses. Quite a mix.
A rich mix, yeah.
And our goal isn't just to, read the news back to you. It's to find those aha moments, show you the deeper implications, and really clarify what it all means for your world.
Let's do it.
Okay, let's start with the global economic pulse. So, July 22nd, yesterday, we saw the S&P 500 close at a new record high.
Good news there.
Dow gained too, but interestingly, the Nasdaq actually dipped.
Huh.
So, kind of a mixed bag in the market. Makes you wonder, what's really driving investor thinking right now?
Well, what's fascinating there, and maybe a bit concerning, is this perspective from Wells Fargo Investment Institute.
Okay.
They've basically observed that U.S. stocks look, well, expensive compared to bonds right now.
Expensive how?
They point to the equity risk premium, which, it measures how much extra return investors expect for taking the risk of stocks versus safer bonds.
Right.
And it's actually negative right now.
Negative. Wow.
Yeah, it's rare. And it's a pretty strong signal suggesting that bonds are, maybe for the moment, seen as a safer bet, potentially offering similar or even better expected returns. It often points to market caution, maybe a reallocation of capital happening.
Interesting. And despite that caution, or maybe because of it, we're seeing this explosion in options trading volumes this year, especially these 0 days until expiration contracts, 0 DTEs.
Oh, yeah, those are huge right now.
They're on track for another record in Q3. For anyone not familiar, these are options expiring the same day they're traded. Super short-term bets.
Hyper short term, yeah. Big potential gains, but also, you can lose your shirt incredibly fast.
So what does this surge in, really high-risk speculative trading tell you? Especially when the big institutions might be getting cautious.
It suggests this kind of duality in the market, doesn't it? You've got maybe cautious institutional money looking at bonds.
Right.
But at the same time, you have this segment, maybe retail, maybe some faster money, just embracing these highly speculative, super short-term plays.
Looking for quick wins in a choppy market.
Perhaps. Seeking quick returns in what feels like a volatile environment, it's a really interesting contrast.
Okay, this brings us neatly to a policy that's making huge waves, financially speaking.
Yeah.
Tariffs.
Oh, definitely.
Our sources really lay out how much President Trump's, aggressive policies are hitting the global economy. We're seeing these recent announcements, 30% tariffs on imports from Mexico and all 27 EU countries.
Wow, 30%.
Plus a 50% levy on copper from Brazil and 35% on Canadian goods. I mean, beyond the headlines, what's the real-world impact of slapping tariffs on seemingly everyone?
Well, the direct consequence, the obvious one, is significant cash for the U.S. Treasury.
Right, you mentioned the number.
Over $128.9 billion in tariff revenues just this year so far, 2025. June alone was over $27 billion.
Huge numbers.
But the deeper, maybe more profound consequence is the direct hit it puts on companies' bottom lines. And it forces this massive reevaluation of global supply chains that have been built up over decades.
And we have a perfect example right here, General Motors.
Yeah, GM.
Their net income actually shrank by 35% in Q2.
35%.
And they specifically point to $1.1 billion in automotive tariffs causing that hit, even though their sales were actually strong.
Right. So sales are up, but profits are way down because of these input costs.
Exactly.
Yeah.
And it's not just an accounting thing. It's forcing them to actually change where they build things.
Adjusting their manufacturing footprint, yeah.
Shifting some production, like the Chevy Blazer SUV, back to the U.S. What does that tell you about the long-term game for these big global manufacturers?
It tells you these policies are forcing these giants to, well, fundamentally reevaluate, maybe even start dismantling these incredibly optimized, decades-old supply chains.
Prioritizing politics over pure efficiency.
It seems like it. Pushing manufacturing back home, even if it costs a lot more, it's a fundamental rewiring, really, of how these massive companies operate. Prioritizing, maybe, resilience and political alignment over just pure cost savings.
And it's not just cars, right?
No, not at all. Look at Philip Morris International. Their stock took a big hit, too. Sales miss. Profit warning.
Aye.
Partly, they say, because of this growing illicit cigarette market in places like Indonesia and Europe.
Avoiding the taxes and tariffs.
Exactly. Which, by the way, is costing the EU something like 14 billion euros in lost tax revenue. So it shows how these policies can sometimes backfire or create, these unintended consequences.
Okay, so on the diplomacy side, there's some movement too. President Trump announced a new trade deal with the Philippines.
Interesting. What's the deal?
Philippines opens its market to the U.S., 0 tariffs coming in. But they pay a 19% tariff to the U.S.
Huh. Seems a bit one-sided.
There's also talk of a potential meeting between Trump and China's Xi Jinping, and that August 12th tariff deadline is looming.
Right, the next big flashpoint.
Treasury Secretary Scott Bessent, though, he anticipates a likely extension of that deadline.
Okay, kicking the can down the road, perhaps.
But then Bessent says something really interesting. He states that tariffs can be used for world peace.
World peace.
And to curb China's dependence on Iranian and Russian oil and its manufacturing dominance. What's the strategy there? Using tariffs for geopolitics.
Well, it suggests they see tariffs not just as economic tools, right, but as instruments of foreign policy, leverage to try and influence behavior, reduce reliance on countries seen as adversaries. Even if it causes immediate economic friction, it's an attempt to reshape global alliances and trade flows using economic pressure. A high-stakes game.
Okay, let's zoom in now on a specific but really heated tariff fight. The 17% tomato tax on Mexican tomatoes.
Yes, the tomato tax.
This isn't just, political chatter. It affects farmers, distributors, restaurants, and ultimately you, the consumer. What's the core issue here?
Well, it's a classic trade policy conflict, really. Creates winners and losers.
Who are the winners?
It's mainly supported by Florida-based field growers. They argue it stops Mexico from dumping tomatoes, selling them at unfairly low prices, which they say hurts U.S. producers.
Okay, so protection for them. But who loses?
It's fiercely opposed by greenhouse growers, particularly in Arizona and Texas, and the importers, of course.
Why?
Well, the big concern is price hikes for everyone else, potentially up to 10% more for consumers and restaurants.
10% on tomatoes, that adds up.
It does. And then there's the jobs impact.
Right, there was a study.
Yeah, a Texas A&M study estimated nearly 50,000 jobs in Arizona and Texas are tied to these tomato imports. So those jobs are potentially at risk.
Wow. And it also highlights issues for those greenhouse growers, doesn't it?
Absolutely. They often find Mexico's climate just better for year-round growing, and they run into problems with the U.S. Farm Worker Visa Program, the H-2A program.
How so?
Well, it's designed more for seasonal, partial-year work, but greenhouses need workers year-round, so the visa program doesn't really fit their business model.
So it's a complex mix of economics, climate, labor policy, all wrapped up in a single tomato tariff.
Precisely. It really shows the tangled web these policies can create.
Okay, amidst all these economic forces swirling around, tariffs, trade deals, what's happening with the Federal Reserve and interest rates, that's always a big question.
Huge question. And we're seeing a pretty clear clash still between President Trump and Fed Chair Jerome Powell.
Trump wants rates lower, right?
Much lower. He's advocating for cutting rates down to 1%. And he's pointing to strong economic numbers to justify it, like, 147,000 jobs added in June, unemployment at 4.1%, manufacturing output up.
Retail sales up too?
Retail sales up 0.6% in June. So he's saying, look, the economy's strong, cut the rates.
But Powell, he seems hesitant.
He does. He seems reluctant to cut rates, sticking to that cautious, data-dependent approach. He's trying to manage inflation, manage growth.
And probably trying to figure out what all these tariffs are actually doing to the economy, right?
Exactly. He has to assess the impact of this tariff blitz. It adds a huge layer of uncertainty.
So the next chance for a cut is that meeting at the end of July.
Correct. July 29th and 30th. All eyes will be on that.
We even heard Mohammed El-Arian, the economist, call for Powell to resign.
Yeah, to preserve the Fed's independence, he argued. citing Treasury Secretary Bessent's accusation of mission creep at the Fed.
But Trump seems to have backed off talk of actually firing Powell.
Recently, yes. He acknowledged Powell's term ends in May 2026 anyway, so maybe less pressure there, but the underlying tension remains.
It's always this fascinating dance, isn't it? Political pressure versus central bank independence. What's the fundamental tension there?
The core tension is always short-term political goals versus the Fed's long-term job,
Which is
maintaining price stability and maximum employment. Politicians often want quick fixes like rate cuts to boost growth now, especially maybe before an election, while the Fed, by its design, needs to be more patient, more data-driven to avoid, overheating the economy or letting inflation get out of control again. It's a really delicate balance.
and it directly impacts everyone's borrowing costs, savings, the whole economy's stability.
Absolutely.
Good.
Mortgage rates, car loans, credit
Yeah.
cards, it all ties back to what the Fed does.
Okay, so we've looked at these big economic forces. Let's zoom in now on how they're hitting specific industries. The auto sector, for example. It's navigating this massive shift towards EVs.
It's a really complex shift, yeah.
General Motors is now the #2 EV maker in the U.S. Tesla
Yep.
is still #1, but GM's climbing.
And GM CFO, Paul Jacobson, he thinks GM has this sort of inherent advantage.
What's that?
Their diverse lineup. They have both gas and electric vehicles. Lots of them.
Flexibility.
Exactly. It lets them adapt if EV demand fluctuates, which it kind of has been. GM has, 12 EV models compared to Tesla's 5?
So they can pivot easier between gas and electric depending on what people are buying.
That seems to be the strategy, yeah. And that flexibility is proving pretty crucial right now.
Especially because, and this is big news, President Trump's new tax and spending bill. It ends the EV tax credits.
The big ones, yeah. $7,500 for new EVs, $4,000 for used.
Gone after September 30th.
That's a huge cliff.
So the expectation is maybe a rush to buy EVs in Q3 before the credits disappear,
Get 'em all you can.
followed by potentially a collapse in Q4 sales.
It seems likely. We've already seen new EV sales dip a bit, down 6.3% year over year in Q2, only the third decline ever recorded.
And Tesla's deliveries were down too, right?
Yeah, Q2 deliveries dropped 14% year over year. That's their second straight quarterly decline.
So how much could losing these tax credits change the whole EV adoption story in the U.S.?
Oh, I think it could slow down mass adoption significantly, at least in the short term.
Boy.
Well, a lot of buyers, especially maybe mainstream buyers, rely on those incentives to make the higher upfront cost of an EV actually affordable.
Right, bridges the gap.
Exactly. Without it, the market might split even more. You'll have premium buyers who can afford it anyway, still buying EVs.
Okay.
But maybe a larger chunk of consumers pausing, waiting for prices to come down naturally, or maybe for new incentives down the road. It could definitely shift the timeline for when EVs become truly dominant.
And speaking of innovation and maybe grabbing attention, Elon Musk just opened his Tesla diner.
In Hollywood, yeah, I saw that.
It sounds wild. 80 charging stations, 2 massive movie screens, 66 feet.
Wow.
And apparently an Optimus robot serving popcorn.
A robot serving popcorn. Okay.
He's thinking about expanding these diners globally. It's quite a vision, merging charging with entertainment.
It really is. It's this fascinating move towards vertical integration, maybe, creating a whole lifestyle experience around the car, not just a place to plug in.
Yeah, more than just functional.
Very much so. And, if we connect this ambition to the wider tech world, the AI trend is obviously a massive driver right now, showing similar levels of, ambition and investment.
Definitely. Futurum Group's CEO, Daniel Newman, he calls the AI trend secular and long-term. Says it's not a short-term bubble.
I think most analysts would agree with that assessment now.
And we keep hearing about agentic AI. AI that doesn't just process information, but actually makes decisions and takes action.
Right, AI that does things.
And the expectation is the big cloud providers, Alphabet, Amazon, Microsoft, are going to show really strong demand for this kind of AI in their Q2 earnings. How big a deal is this shift towards AI that acts?
Oh, it's transformative, potentially. This isn't just about, slightly smarter search results or better product recommendations.
Right.
It's about AI having more autonomy to handle complex tasks, which in turn drives this incredible demand for computing power.
And talent, presumably.
Huge demand for talent. Look at Microsoft. They've reportedly hired around 24 top AI people away from Google DeepMind.
Including former VPs.
Yeah, big names. For their Microsoft AI group, working on Copilot, Bing.
Yeah.
It's a real talent war out there.
But didn't Microsoft also just have big layoffs?
They did. Around 9,000 employees recently as part of cost cutting. So it's this strange mix of massive investment in strategic areas like AI alongside broader cuts.
And we're seeing Oracle getting involved, too, with OpenAI's big Stargate project.
Yeah, that's aimed at massively boosting AI data center capacity. But analysts are asking, how is Oracle going to pay for these huge upfront costs, betting on future revenue, basically?
So it highlights the sheer scale of investment needed for this AI infrastructure.
Absolutely. Massive capital spending is required. Companies like Oracle are making these enormous, somewhat speculative bets, hoping to become the backbone for this AI revolution, but it's definitely high risk financially.
Meanwhile, there are still these big cybersecurity worries.
Always.
Microsoft reported Chinese hacking groups exploited a vulnerability in SharePoint.
Right. Linen Typhoon, Violet Typhoon, Storm 2603. These groups apparently got in through SharePoint.
And this comes after Microsoft made cybersecurity a top priority, following that earlier breach of U.S. government emails.
Exactly. They got criticized pretty heavily by a government report for how they handled that, so this is not a good look.
They're also stopping reliance on China-based engineers for Pentagon cloud stuff.
Yes, which speaks volumes about the geopolitical tensions wrapped up in all this tech development. Security is paramount, especially with critical infrastructure.
Okay, let's pivot now to something closer to home for many listeners: real estate and taxes.
Always relevant topics.
We're seeing home builder stocks like D.R. Horton and PulteGroup actually rallying, which is weird because the housing market itself seems kind of weak overall.
It is a bit strange, but D.R. Horton says they're planning to boost home buying incentives, do some localized price cuts.
They're adapting, being aggressive to keep sales moving in a tougher market.
Seems like it. They're finding ways to navigate it.
And tying into that affordability theme is this really interesting debate in Florida. Governor Ron DeSantis proposing to eliminate property taxes entirely.
That's a huge proposal. Really shakes things up.
Let's put this in perspective for someone maybe thinking about moving.
Mm-hmm.
A $600,000 house in, say, California, New York, New Jersey, high-tax states, you could easily pay $8,000, maybe even $13,000 a year in property taxes.
Yeah, easily.
In Florida, that same $600 K house might be around $4,900, and that's before any homestead exemption.
That is a massive difference. We're talking thousands of dollars every year.
So for someone moving to Florida, the savings could be really significant. You've already got no state income tax.
Right, that's another big draw.
Which could save a household earning, say, $150,000, maybe $8,000, $10,000 a year right there.
Okay.
Add in the property tax difference, total relocation savings could be $10,000, maybe $20,000 annually.
That's serious money.
One analysis even suggested total savings of $45,000 a year, plus maybe a $1 million windfall, just from the difference in home values for someone moving from California to Florida, hypothetically, of course.
Wow. But okay, the huge question is, if you eliminate property taxes, which fund schools, local services, how do you replace that revenue?
Exactly. That's the multi-billion-dollar question.
Would it mean much higher sales taxes? Or other taxes.
That seems like the most probable route, higher sales tax.
Which could end up hitting lower-income households harder, right? Since they spend a larger portion of their income on goods subject to sales tax.
That's the potential downside. It's a trade-off. Attract higher-income folks with low property and income tax, but maybe increase the burden elsewhere, potentially on those with less ability to pay.
A really complex equation for the state to figure out.
Definitely. And beyond taxes, companies are also looking at their physical spaces, their offices, trying to make them more efficient.
Especially with hybrid work being so common now, understanding how space is actually used is key.
Which brings us to this startup, Butlr. Based in San Francisco, about 6 years old.
What do they do?
They use these anonymous body heat sensors, no cameras,
Okay, anonymous is important.
and AI to figure out how office space is being utilized, like occupancy levels, foot traffic patterns where people are meeting.
Ah, data-driven real estate decisions.
Exactly. This data helps companies figure out, the best layout, design choices, maybe fine-tuning hybrid work schedules, even planning maintenance or negotiating leases.
Making the office more productive, more collaborative, based on real usage, not just guesses.
Right. And they've raised $75 million in funding, so clearly there's demand for this kind of tech.
Makes sense. But it's worth noting, too, that actually upgrading offices, doing those fit-outs, the costs for that are rising. Material prices are up, labor shortages. So even as companies get smarter about using space, actually changing the space is getting more expensive. Another complex calculation for businesses.
Always trade-offs. Okay, let's shift gears a bit now to personal finance fundamentals. Let's talk credit.
Super important topic. For a lot of people, getting started with credit or maybe rebuilding it after some trouble can feel really daunting.
Yeah, where do you even begin?
Well, the good news is there are tools specifically designed for this. Easy to get credit cards aimed at building or rebuilding. And the key thing isn't finding like one magic card, it's finding the right tool for your specific situation right now, and then using it responsibly over time. Consistency is key.
Right. So what are some examples? If you have, say, fair to good credit already.
The Capital One Platinum credit card is a good option. It's unsecured, which means no security deposit needed.
And no annual fee.
No annual fee. So it's a straightforward way to build history if your credit's okay.
What about students? Starting from scratch.
For students, the Capital One Savers Student Cash Rewards card is great. Again, no annual fee, but it also gives cash back on things students actually spend money on. Groceries, dining, entertainment, helps build credit and gives a little back.
Nice. What about just a general good cashback card, no annual fee?
The Citi Double Cash Card is very popular. Simple structure. 2% cash back on everything. You get 1% when you buy something and another 1% when you pay it off.
Okay, straightforward. But what if your credit isn't great, or you're really just starting out, need something easier to qualify for?
That's where secured credit cards often come in. These usually require a security deposit, which acts as your credit limit.
Lowers the risk for the bank.
Exactly. Options there include the Bank of America. Customized Cash Rewards Secured Card lets you pick bonus cashback categories. Or the First Progress Platinum Prestige MasterCard Secured. This one has a low interest rate, which is good if you might carry a balance, plus 1% cash back on payments.
So even secured cards can offer rewards now.
Some do, yeah. Another is the Capital One Quicksilver Secured Card. That one offers a flat 1.5% cash back on everything, which is really good for a secured card.
Is there anything for people with literally no credit history? Like maybe they're new to the country or very young?
Yes, the Pedal 2 Cashback No Fees Visa card is interesting. It can use your banking activity, like your income and spending patterns, to help determine eligibility, not just a credit score.
Ah, alternative data.
Right, and it boasts having no fees whatsoever, so very accessible for credit newbies.
Okay, so lots of options depending on your situation. But what's the universal advice for actually building credit with these cards?
It's simple but crucial. Two things. One, make your payments on time every single time. Payment history is the biggest factor in your credit score.
Okay, number one, pay on time.
Number two, keep your credit utilization low. That means don't max out your cards. Try to use only a small percentage of your available credit limit, ideally under 30%, even better if it's lower.
Got it. Pay on time. Don't use too much of the limit. That's the foundation.
That is absolutely the foundation for building strong credit.
Okay, shifting from building credit to thinking longer term, retirement.
The big goal for many.
Northwestern Mutual recently estimated the magic number needed for a comfortable retirement is now $1.26 million.
That's a lot of money. Feels daunting for many people.
It does. So are there strategies to make retirement income more secure, maybe inflation-proof?
One interesting strategy, especially if you're nearing retirement, involves Treasury Inflation-Protected Securities, or TIPS.
Okay, TPS, how does that work?
Well, one approach is you could potentially cash out a portion of your 401k when you retire and use that money to buy what's called a bond ladder made up of TIPS.
A ladder, like buying bonds that mature at different times.
Exactly. You buy TIPSs with different maturity dates, say, maturing every year for the next 10, 20, even 30 years.
Okay.
And the key thing about TIPSs is their payout value automatically adjusts upwards with inflation.
Ah, so the income keeps pace with rising prices.
Precisely. It provides a guaranteed inflation-adjusted income stream for potentially up to 30 years. It really helps protect your purchasing power throughout retirement.
That sounds like a powerful tool for income security. Okay, let's switch gears again to student loans. Big changes there, too.
Huge changes coming. President Trump's recent big, beautiful bill, as he called it, created a whole new repayment plan.
What's it called?
The Repayment Assistance Plan, or RAP. RAP. It's supposed to be available by July 1st, 2026.
Okay, RAP, how does it work? Is it like the existing income-driven plans?
It is an income-driven plan, yes. It calculates your monthly payment based on your adjusted gross income, your AGI.
You have the payment amount.
It's on a sliding scale from 1% up to 10% of your earnings. But there's a minimum payment of $10 a month.
1% to 10%. That sounds potentially lower than current plans for some people.
It could be, depending on your income and family size. But there's a catch, or maybe a trade-off.
Okay.
Loan forgiveness under RAP doesn't happen until after 30 years of payments.
30 years. Wow, that's longer than the current plans, right? Those are usually 20 or 25 years.
Exactly. So you might get lower monthly payments, but you'll be paying for longer before any remaining balance is forgiven. That's a really important consideration for borrowers.
And is this RAP going to be the main option going forward?
It seems like it. For new borrowers after July 1st, 2026, the main choices will likely be just RAP or a standard fixed payment plan. Fewer options than before.
Are there any other perks to RAP?
There are a few interesting ones. You can get $50 off your monthly bill for each qualifying dependent you have.
Okay, that helps families.
There's also a subsidy if your payments are so low, they don't even cover the interest. The government will cover the remaining interest so your balance doesn't balloon.
That's helpful.
And payments made under RAP will count towards public service loan forgiveness, PSLF, if you work in a qualifying job.
Okay, so it's a really complex package. Lower payments potentially, but a much longer forgiveness timeline for most. And it simplifies the options going forward.
That sums it up pretty well. It's going to significantly reshape the student loan landscape.
Okay, so with all these policy changes, economic shifts,
Yeah.
what does it all mean for how we're actually working and living day to day? We're seeing a really interesting trend with side hustles.
Oh, yeah. What's that?
For the first time since 2017, apparently fewer Americans have a second income. The number's down to 27%, from 36% just last year.
Huh. That is interesting. Why the drop?
Bankrate, who did the survey, they attribute it mainly to a solid job market
Okay.
and wage growth finally outpacing inflation, at least for a while there. So people feel less economic anxiety, maybe.
Less pressure to hustle for extra cash if your main job feels more secure and pays better. Makes sense.
Leads to maybe more discretionary spending, less need for that second gig. Bankrate does think it might rebound if the economy cools off. But for now, it suggests maybe a bit less financial stress for some households.
A positive sign, potentially.
But not all sectors are feeling positive. The grocery industry seems to be struggling.
Yeah, that's been a tough space.
Homeland Acquisition Corp., a supermarket operator, is closing 5 stores because they just weren't performing well financially.
And that reflects a bigger trend, doesn't it? Conventional supermarkets losing ground.
Exactly. Losing market share to the big guys, the mass merchandisers like Walmart and Target, and the club stores like Costco.
Why is that?
Well, high inflation's a big factor. People are hunting for value. Plus just increased competition everywhere. And consumers changing their shopping habits, maybe more online ordering, different store preferences.
It's forcing consolidation and closures, like Kroger closing 60 stores recently.
Right. They're trying to get more efficient, especially after their huge $25 billion merger with Albertsons got blocked by a judge. So major restructuring happening in how we buy groceries.
Definitely a sector in flux.
But it's not all closures and gloom. We do have one lighthearted consumer story here.
Oh, good. Let's hear it.
A new Chick-fil-A is opening in Brooklyn.
Okay. Big deal in some circles.
And for opening day, they're offering free meals to anyone who shows up dressed in a full cow costume.
Huh. That's classic Chick-fil-A marketing.
It is. And on a more serious note, that one restaurant opening created over 75 jobs.
So even amidst these big industry shifts, you still have local investment, job creation, and, well, people willing to dress like cows for free chicken.
Exactly. A reminder that consumer engagement is still alive and well.
Good to hear. Okay, finally, let's touch on cryptocurrency. What's the latest there?
Well, a big hurdle for wider adoption seems to be just knowledge, or lack thereof.
People just don't understand it.
Largely, yeah. A survey from the National Cryptocurrency Association found that for 90% of Americans who don't own crypto, the main reason they cite is simply a lack of knowledge.
90%. That's huge, especially with Bitcoin near its all-time highs again and new regulations coming in.
Right. Despite all the buzz, only about 1 in 5 Americans actually own any cryptocurrency right now. So there's this massive educational gap still.
Definitely something the industry needs to address if they want mainstream adoption.
And maybe regulation will help bridge that gap. We are seeing legislative progress.
We are. President Trump signed that stablecoin bill into law, the Genius Act.
Guiding and establishing national innovation for U.S. stablecoins. Gotta love the acronyms.
They do love their acronyms. And the House also passed the Clarity Act, which is meant to provide, well, clarity on broader crypto market structure.
So that sets the stage for the Senate.
Exactly. Senate banking leaders are apparently moving forward with discussions on digital asset market structure. The goal seems to be creating clear rules protecting investors.
And positioning the U.S.
Positioning the U.S. to be, and I quote, a crypto capital of the planet.
Ambitious goal.
Very. But it suggests a real push now to bring regulatory clarity and hopefully mainstream acceptance to the crypto world.
Which could, in theory, make more people comfortable actually getting involved.
That's certainly the hope. Provide that clear framework, build confidence, and maybe unlock more participation from both big institutions and everyday investors. Could be a catalyst for growth.
Wow. Okay, what a deep dive that was.
We covered a lot of ground.
Seriously, everything from the complexities of global tariffs, the Fed's interest rate bans, to the AI talent wars, clever ways to use office space, and all these shifts in personal finance, credit building, retirement, student loans, and even retail.
It really shows how interconnected everything is, doesn't it? Policy decisions over here impact industries over there, which changes consumer behavior.
Absolutely. It's clear these forces are shaping our economic reality, our daily lives, in ways that are sometimes surprising, often pretty profound.
Indeed, we're definitely seeing both, unprecedented challenges like these supply chain resets, but also really remarkable innovation happening across the board.
Technology, policy, consumer habits, it's all interacting in ways that feel more complex than ever.
Creates a lot of volatility, but also a lot of opportunity, I think.
Okay, so let's leave our listeners with a final provocative thought to chew on.
Right.
With all these new tools and policies emerging, we talked about AI agents changing cloud services, new student loan plans like RAP, these different credit building cards, TPS for retirement. How will all these innovations reshape not just our financial choices, the decisions we make, but maybe the very definition of what personal economic security means in the years ahead?
That's a deep one. How technology and policy redefine security itself. Lots to think about there.